myself to the stage. All right. So give me a second. We are pulling up. Let's see if I can. No, that's not working. Let's do this one. All right. Give me a second. I was hoping this didn't happen, but we're going to get it right. We are going to get it right. We're going to get it right. Give me a second. We are live. I know we are live, right? But we are going to get this right. Okay, so we got this screen. Let's move this. All right. So anyway, we are going to go live. This is your boy Joe, the Wealth Architect, and we are going to talk about the SSI method. And the SSI method is a 3-part wealth building framework that I created about 4 years ago. And it is based on having a system for building wealth, right? Not just platitudes or nice sounding words or anything like that, but an actual system, right? That's easy to follow and that over time can help you build wealth. That's what the SSI method is about. The SSI method has 3.3 pillars: spending plan, right? A plan for how you're going to spend, how you're going to be the boss of money and direct where your money goes instead of trying to figure out where did it go, right? There is a savings plan, right? How to be very intentional about your savings and breaking it down into different categories for different purposes. And then last but not least, the investing plan, right? That's the one I like the most, to be honest, right? They're all important and they all go together, but the investing plan is where the wealth is actually built, right? And so that's what we're going to talk about today. Please bear with me as I set up the slides, right, for today's webinar. Just give me 1 second. All right, it said share screen, and I tried to share the screen. So let's see. All right, give me a second. Let's see, new screen. Is that it? No speakers. Okay. All right, again, bear with me. Let's see. You all that's not working. Okay, you all are getting to see behind the scenes in real time, right? Let's see. I have the slides ready, but they're not showing up as I want them to. So I'm not sure about that. Let's see if this is it. Maybe this is the reason why. Let's see. All right, let's see. That's not it either. Okay, so that's not it. Oops. That's not it. We're going to get it. I promise you, we are going to get it. We are going to figure this out. Bear with me. I am using StreamYard. Anybody familiar with StreamYard? I am happy to take some input to see how we can figure this out. For some reason, it is not working. Just give me a second. Again, this is in real time, so this is what it is. All right. Okay, give me a second. All right. All right, give me a second. I'm trying to get back up here. It's not, but I'm. Okay, sorry, I apologize. The good thing about this is my attitude. Once I figure it out, right, then we're all set going forward. So that's the beauty of it. So we are not going to panic or anything. We are going to try to set this up properly. We're going to try to set this up properly. You can see me, but I am unable to share the slides. So here's what we'll do, right? For now, we're not even going to use the slides, right? Because that'll take up too much time and I'll value your time, right? So again, this is Joe, the Wealth Architect. For any of you who have been following me on YouTube, you know that I have been teaching personal finance and entrepreneurship since 1995. It all started when I was incarcerated as a much younger person in my 20s. And one of the things that really changed things for me is that I realized that I kept getting in trouble with the law because I was, as they say, chasing the bag, trying to make money, right? Responding to poverty and life circumstances in my community, and ended up getting in trouble with the law. And so while I was in prison as a 22-year-old, 23-year-old, um, the light bulb finally went off, and I realized that I had to get at the root of it. Right? We can blame society, we can blame racism, we can blame a whole bunch of things, right? And even though they are real factors, right, that can cause people or push people, so to speak, to commit crimes, right? uh, it's still not an excuse at the end of the day, right? And so what I realized, it was about making money. And so if I wanted to change the trajectory of my life and stop getting in trouble, make the most of my life, and be the best version of myself as my mother wanted me to be, and as I knew I could be, then I really had to learn about how money works, right? And so that's for me how it all started in 1993, 1994. So we're talking a long time ago. The light bulb went off, and I started reading books about personal finance, investing, budgeting, annuities, retirement, you name it. I mean, I just kept devouring books and magazines. I started getting magazine subscriptions, newspapers, and I just haven't stopped. After I really like kind of got a somewhat of a grasp of it in 1994. A year later, I ended up, I was transferred to a different prison in New York State, closer to New York City, where I'm from, and I began teaching. I was asked to teach a class, and I started teaching classes on personal finance, and I was hooked. After the first time, I was like, okay, this is it, right? It helped with my competency, my confidence, and the really good part is that I knew I was having an impact on other people, a positive impact, and that meant a lot to me. And so that's what I've been doing ever since. And so uh, the SSI method came about many years later, right? My first book, right? The SSI method is my second book. My first book is Think Outside the Cell, right? An entrepreneur's guide for the incarcerated and formerly incarcerated. And I wrote that and published it in 2007, so almost 20 years ago. And oh, wait, give me 1 second. And so I wrote that in 2007 because I had, like I said, I've been teaching both personal finance and entrepreneurship since 1995, and I would get questions about both from my peers, incarcerated men, and a lot of people wanted to start their own business, right? They had the hustle mentality, they had the grit, they had lived experience from being on the other side of the law, the wrong side of the law when it comes to investments, and they wanted to know more, how to go legit. And so I began teaching classes and enlisting other people, right? My peers, some of my peers, my very close friends, to also teach with me, right? So we had like a cadre of us who were teaching entrepreneurship and also personal finance, right? So that's just a little bit of background on me, and I just want to dive in because that's why you you came here to this live, right? So the SSI method came many years later, right? During the pandemic, it was around 2002, right? And I was talking to a longtime friend of mine, a dear friend of mine, Kenny Ennis, and he was talking about how at at the time he was about 62 and I was like 52, and so he was talking about how his best friend was about to retire. They had grown up together, and they, went to the military together, married sisters, and his friend was about to retire because he's in his early 60s, right? So he had not gone to prison, worked all his life, and was ready to retire. And my friend Kenny, however, could not retire, didn't have the luxury of retiring, right? Because he didn't have any savings because he had been in prison for 27 years for a crime he did not commit, right? And so just having that conversation with him really resonated with me. Now I'm 10 years younger than Kenny, but it made me think about people like myself who did a significant amount of time, 10, 15, 20, or even more years in prison. And yet when they got out, because they didn't work in they worked in prison perhaps, but they didn't work on the outside. They did not have anything to look forward to in terms of financial, unless they were fortunate to have a loved one leave them some money or something like that. And that's very rare. I mean, it's just very rare. The truth is that most people who end up in prison come from impoverished backgrounds, right? Meaning was a lack of monetary resources in particular, right? Maybe love. We had love in the household, but we didn't have a lot of money. We had a lot of material things. So, but anyway, so Kenny, and when he told me that, the light bulb went off, and I was like, wow, Kenny and myself and so many people, tens of thousands, hundreds of thousands of people, if not millions of people, experience that every year, meaning you do a significant amount of time in prison and then come home after 10, 15, 20 or more years and have little to no savings, no retirement fund, no IRA, no 401k, no any of that, right? So it's really starting from scratch, right? And on top of that, and this is key, on top of that, there's no financial literacy. In being more specific, there's no financial reentry plan. There's no financial reentry plan, right? It's like you go home, maybe you get $40, $100, $200, or whatever case might be. In New York State, it was $40 for many years. I think now it may be 200 or 250. You still can't do much with that. I mean, it's $250, and you're expected to not reoffend, right? To if not excel, to not get in trouble, right? And to successfully reintegrate. And so the main focus, though, for a lot of in terms of the system and reentry organizations, is to get you a job, right? Even though you have the stigma of incarceration, right, which makes it very difficult to get a job. Not impossible, but very difficult. So to get a job, to get a place to stay, right, so that you're not in a shelter. Many people, I don't know the percentages, but a large number of people coming to New York City come home to a shelter. Some people for the first time. Other people they've been in the system before, but it's still a horrible place to be in. And healthcare. So housing, employment, and healthcare. The most is the three. I would say the three kind of pillars to get a person grounded after long-term incarceration. But there's no talk about savings. There's no talk about budgeting. There's no preparation for it, and certainly no preparation for investing. And that is why a lot of people end up resorting back to crime because they cannot survive. Not because they are criminals, like natural criminals. Some people think that they can get over. I'll just do this one thing or whatever. I'm not justifying. The only thing I'm saying is that without a financial blueprint, without a system to help you and me and others to think about money a certain way, to have a relationship, build a relationship with money so that you are thinking correctly for one, and thinking from a growth mindset as opposed to a scarcity mindset. Without that, then the odds are against you, right, for successfully reintegrating. Of course, it's not impossible. People don't reoffend, right, or don't get caught. Let's just say that. But some people end up being a drain on government funds. Let's just be honest, right? You end up on welfare. Now, if it's in my opinion, is that it's meant to be a temporary thing. A temporary could be 6 months, could be a year, it could be 2 years, right? But it should not, in my opinion, if you're able-bodied, be a 5-year plan, a 10-year plan, or a forever plan, right? Because that's what you were exposed to. But with the SSI method, which like I said, consists of three parts: a spending plan, a savings plan, and investing plan. When you have those in place and you work the system, you create a system, right? And I'm going to lay out each of the pillars and in a minute. But when you have a system and you work the system, you tweak it every now and then. So as you know, things in your life changes. But if you have a system, you have structure. And many of us, most of us, who ended up in prison or jail, anywhere in the country or the world for that matter, lack structure, right? Lack structure. Not just discipline, anything like that, but we lack structure, right? So we want to change that by, again, making sure that you have a system that works for you. So the SSI method, let's get into it. Let's dive into it. Let's see also, I'm not sure if we can get comments because I welcome comments. Let's see if we can get any comments. You can chime in if you have any questions, right? But so the SSI method again is three parts. Spending plan. Let's talk about spending. Why do you need a spending plan? Why, you hear the stuff about having a budget, right? I'm not against budgets, right? But I think when people hear the word budget, they often tense up, so to speak, right? We think of budgets as being restrictive, right? Meaning that they limit what we can do with our money, right? And we want to do whatever we want to do with our money. In fact, I've met a woman several months ago, maybe 4 months ago or so. I was doing a presentation, a live presentation, and we had a chat before I got started, and she talked about how when she was on, it was an interesting conversation because she talked about how when she was incarcerated, formerly incarcerated. So she talked about how when she was when she was incarcerated, she developed I guess you would say, the discipline to manage her money. Right? She didn't make much, but she was able to manage what she made. Right? Which is what most people end up doing. Now, there's a lot of people also, and I'm saying from observation, who don't manage their money well, no matter how much money they have, right? They spend it all, and then they struggle with not having food or soap or basic things while they're incarcerated, right? And even if they're fortunate to get money from the outside, meaning somebody, loved ones, friends send them money, many of them they squander it. They squander it. We know that that's the truth, right? For anybody who's been incarcerated, I might be talking to you, right? And so they squander it. And let me give me 1 second here. I just want to make sure I have this right. Okay. They squander it because they have not been taught about money, right? The purpose of money, how to use it, not abuse it. And so it's no wonder why people struggle with it. Why, before they went to prison, during incarceration, and then after incarceration, right? Because it's habitual. We are habitual creatures, right? So anyway, so speaking to this woman, and she was saying how when she was inside, she didn't have a lot of family support, and so she knew she had to make the most of what she did have in terms of money, right? And that's actually a good thing. I actually read one. I have several. Damon John's Shark Tank from Fubu, one of his books. I forgot the title. I have it at the house, but it was talking about broke, right? How being broke can be a good thing, and you might be saying, "Well, how can that be true?" Well, it's because it makes a lot of sense, right? To me, at least, because when we have, I'm not gonna say a lot of money, but we have more money than we need to live off of. Let's just say that, right? Often we will just willy nilly just spend money on anything, any and everything, right? Instead of being more intentional with how we spend our money. And so when you are broke, or I am broke, or you're or close to it, you at least you should be thinking about how you spend your money, right? So sometimes being broke, my point is that it's not a good feeling. Don't get me wrong. I've been there, been there numerous times in my life, right? But what it does is it makes you much more keen and much more sharp in terms of paying attention to how you spend your money because you don't have that much, right? If you got $1 million versus whether or not you have $100 or $500, you're going to likely spend the money somewhat differently, right? If you're a spender, you're going to spend anyway, right? But if you have $1 million, you're going to really go crazy, right? Like a lot of people who win the lottery, who are entertainers or athletes, anything like that, because they have no formal training when it comes to money, right? They listen to the people in their camp, their so-called advisors, and all this other stuff, who talk a good talk, and they end up messing up their money. So anyway, going back to this woman who I met at before I gave a presentation, she said that now that she's home, right, or since she's been home, she now can't seem to keep money, right? And some of you may know what I'm talking about, right? You're a spender, right? She, instead of trying to save or invest, anything like that, she basically said, if I see something I want, now that I can get it, right? Meaning there's no restrictions. I don't have to wait until commissary for 2 more weeks or another week or another day. If I have the money, this is her rationale. It's a lot of people's rationale. If I have the money, I will spend it on something I want, right? Because I can. That's the thinking, right? That type of thinking is what gets us in trouble when it comes to the SSI method, spending, saving, investing, but more importantly, just in general, day to day, that type of thinking is what holds us back and keeps us in a hole, keeps us in a bind, keeps us having to work until we 70, 75, right? That's not what I want, and that's not what I want for you, right? So keep that in mind when we talk about whether or not you can afford something, because that's what I said. I wasn't trying to preach anything like that. But having the money or having the credit card does not mean that you can afford something, right? Because if you have goals, if you have priorities, if you have bills, if you have credit card debt, you have all these other things, then just because you have money in your pocket, or just because you have a credit card with some more money on it, somebody else's money, because it's not your money, right? Doesn't mean you can afford it, and that's critical. That's critical to know. Having the money and being able to afford something is two different things. When you have goals, you can have $1,000. Let's say, let me give you a perfect example. You have $1,000 in your bank account, right? Then you go, let's say, shopping for some basic items, right, at a department store, whatever case may be, and then you see, or I'll give you a good example. You have a job, right? You have a job opportunity. So a job interview. So you go, you get a suit, or a dress, or whatever, whatever. You get a nice outfit for that. But while at the department store, right, you see all this other stuff, right? Meaning you go to, even if it's a discount store like Burlington or something like that, you see other clothing items that you like. And so in real time, impulsively, you say, okay, oh, I like this. This is nice. Oh, this, and it's on sale. That's how they get you, right? It's on sale. Who doesn't like sales, right? But if you have a whole bunch of things that you accumulated, right, that meaning that you purchased because it was on sale, then you end up spending more than you intended to, and you haven't taken into account whether or not you can pay off your other debts, right, or pay off your debt, if you can save for whatever it is you said you might want to save, or if you want to invest. The term they use for that in when it comes to money uh, is opportunity cost. So when you spend money on one thing, right, meaning you purchase a whole bunch of things that are on sale, and you purchase them impulsively, instead of putting the money to work for you in investing, or at least saving it, then you give up the opportunity to have more money later, right? Uh, when it comes to investing, you could possibly have a lot more money, right? But you've given that up. So it's the opportunity cost uh, of your spending now and trading it off for a better tomorrow, so to speak, right? Or a more comfortable tomorrow. So always be mindful of that, right? The way money works is it's not just money per se. It's money in two things: money and time. That's the biggest thing, right? So money over time that is put to work, and that's critical. So it's two. Money has to be put to work, meaning that it has to be invested. It has to be invested in the business, in real estate, in stocks and bonds, and or even intangible things, right? It can be invested in your education, right? Whether you're reading books, whether you're in school, whatever the case might be, money uh, needs to be invested in order for it to multiply, right? We're not we if we're gonna do math, let's think in terms of multiplication instead of subtraction, right? When you are just buying, spending, then you're playing a subtraction game, right? When you're saving, then we're talking arithmetic, right? So your money can gradually grow, right? But you want it to make sure that you are putting your money to work, that you make it work as hard as you work. I mean, that's the bottom line. We bust our behinds, some people for decades. After high school, they go to college or not, right? And then for the next 30, 40 or more years, we work. And guess what? We also do. We spend, right? So there's not a lot of saving, and there's very little for many people in America. There's very little investing, and therefore the money is not growing. It's really not growing, and therefore, as I mentioned earlier, you end up having to work longer and harder, right? Most of us, when we're in our 50s, 60s, or even earlier, whether we call it retirement or not, it doesn't matter what you call it. We want to spend time doing the things we like to do, right? And often it's not work. It's not traditional work, right? Often what we'd like to do is spend time with family members and friends. But if you don't save and invest along the way, and you only spend or mostly spend, then you're making it, you know, next to impossible, right? And all of this can be avoided. So anyway, I just wanted to mention that in the context of the spending plan. The spending plan is about being very clear about you being the boss of money. You being the boss of money, not money bossing you. The spending plan is about being intentional with how you allocate your money. You want to make sure that every dollar, right, has a purpose. You can give it a name, right? I have, for example, after my expenses and also like that, what I call play money, right? And I'm not talking about gambling. I don't gamble. Some people, that may be their thing, their side hustle, not side hustle, but their kind of recreation or whatever. So, but I don't gamble like that. But it's play money because emotionally, not just financially, but emotionally and psychologically, I don't feel like it's my money that I feel like I either earned on my own or my money. Often my money is working for me, and so that's money that I have to live like just without any uh, guilt or shame or anything like that. That's what I mean by play money, right? So you can literally, if you have $100, let's say, right? The idea is to allocate your money into three buckets: so how much you're going to spend, how much you're going to save, how much you're going to invest. It's really that simple, right? Some it might be zero, who knows, right? But it's spend, save, invest. And so if you think about it like that going forward, right? And I don't care, like I said, if it's $100, if it's $1,000, the dollar amount doesn't matter. The system is what matters. Having a system and a structured system for how you're going to allocate your money. Now, the percentages that you allocate to each amount also is going to be unique to your situations, right? So everybody's different. There's no, you hear about the, um, what's that, the 50-30-20 rule, the 70-30 rule, all these different rules, right? The way I think about allocating money for the SSI method is this. When it comes to mutual funds, particularly when it comes to, and I'm getting a little advanced here, right? A little ahead of myself. But when it comes to employer-sponsored retirement plans, such as a 401k, right? They often, right? It's like I said, a company sponsored or employer sponsored, meaning your boss, your company sponsors a retirement plan. They connect with a Fidelity, a Vanguard, Charles Schwab, something like that. And then you have uh, a range of investments to choose from, right? Usually you have to pick one, and one of those often is called a target date fund. A target date fund. And the way that works is that it calculates your age, right? Subtracts your age, your current age, from when you're likely to retire. So let's say 65, 67, or whatever case may be. Let's say you're 30. So you have 37 years, right? So let's say 35, right? Let's say your plan is to retire at 65. You're now 30. So you got 35 years of working, presumably, right? So with a target date fund, you will plug in the year that you intend to retire, and it automatically, I do like them a lot, it automatically calibrates a percentage of your fund, of your investments, that will go to stock investments, which is more growth focused, right? Growth oriented, and fixed income bonds, right? So the younger you are, right? Uh, the younger you are, the fund will automatically front load, so to speak, more stocks, more investing in stocks, right? So you might have 70, 80% in stocks at age 30. But as you get older, right, in your 30s, your 40s, your 50s, then the equation changes automatically. You don't have to do anything but keep investing, right? And so as you get older, it will shift from 70%, let's say, stocks to maybe 70% bonds as you get to 55, 60, 65, right? The reasoning is this. When you are younger, when we are younger, we have a lot more runway going. Think about an airport, right? You have a longer runway from 30 to 65 than from 60 to 65, much shorter time span, right? And so when you're younger, you can be a little bit more aggressive, right? You can invest in stocks, for example. You can invest in mutual funds of different types. And the reason why you can do that is because you can weather the storm. Stocks and investments in general are volatile. Some are more volatile than others. Volatile meaning that they fluctuate. They go up and down based on a whole bunch of factors, right? So it's not like a guessing game, or you shouldn't be guessing. It's more that they go up and down. And so with a target date fund, it basically, like I said, front loads you at when you're younger into stocks, right? So that during the ups and downs, since you have a long runway, you have more time to recover, right? If the market is down for a year, half a year, or 2 years, like when we had the pandemic, took like 18 months or something like that for the economy to begin to pick up steam again, right? These things happen. Some things we can't anticipate, and some things we can't. When you have a war, for example, we had war with Iran, or the country is at war with Iran, that's going to affect oil prices. It's going to affect a whole bunch of things in terms of prices. And so companies, when public companies feel the pinch of cost for them, for the company, they pass those costs down to you and I, right? And so things like that affect the stock price, right? So again, my main point is that when you're younger, you can afford to take more risks. As you get older, you want to take less risks, right? Because you want the money to be around. That's the point. It's not whether or not you like risk or not. It's a matter of you want to have money all of your life. You don't want to be struggling. That's another reason why you want to invest and not just be thinking for now, right? For today. Because if you only think for today, then you only have for today, right? If you think long term and you are vigilant, you don't have to watch your investments every day and anything like that. But if you're paying attention to what's going on in the world and to what's going on in your investments, you check in from time to time, make certain adjustments, then you are likely to do a lot better, right? So that's a long way of saying that for me, it's not so much a 50, 30, 20 kind of setup, right? In terms of how you allocate your funds. It's more so in your 20s, like a target date fund. That's why I mentioned this. A target date fund, in a similar way with the SSI method, I use the approach that is used for target date funds, right? So that when you're younger, I do agree that you should, or believe that you should invest more heavily. It doesn't have to be aggressive, but more heavily in stocks, particularly in the S&P 500. S&P 500 stands for Standard and Poor's 500. It's the 500 largest companies in America. All mutual funds offer some version of an S&P 500 index fund. An index is basically a basket of similar types of investments. So in the case of the S&P 500, we're talking about 500 of the largest stocks, right? Companies that issue stocks, right? And it's like 11 sectors, 74 different industries. So it's going to cover all bases from industrial to automotive to tech to healthcare, all of those, right, in one basket. That's the beauty of it. And just so you know, the S&P 500 has historically over the last century, over 100 years, has averaged about anywhere between 8 and 10% a year, right? 8 and 10% a year. So keep that in mind, because some people might say, well, I'll just put it in the bank. You're not going to get 8% ever, from the bank. The last time I saw rates at 8%, and they were, right? I think it was 8.25, was in 1989. 1989, right? I was in college at the time. And I remember and that was my first time opening a bank account. I was, young man. And I didn't know anything that I know now, right? So I didn't know if that was good or bad, but I know that it was about 8% at the time. And I have not seen rates that high. And keep in mind, if a bank is given, any bank, right, is offering or giving 8% on a savings account or CD or something like that, that means the price of bonds, the price of almost everything is probably double that, right? Meaning inflation. That there's so much money in the market that in order for banks to be competitive, they have to give you more money, because you can put that money somewhere else. They're in the business of making money, so they know this, right? But again, the main point is, when it comes to a bank account, my suggestion is to start with a high yield savings account, not any regular savings account. It just makes no sense. And even a high yield savings account, I mean, it's better than a regular account right now. In 2026, you might get anywhere between 3 and 4%, which is better than nothing. But again, your money is not working for you as much as it could if it were invested in index funds or some type of stock or something like that, right? So keep that in mind. So spending plan, right? That's a mouthful. Spending plan. You want to, when you're in your 20s, you're going to allocate a certain amount, right? It might be 70, because you don't have a lot of expenses. You might have 60 to 70% that you spend, right? Maybe for college, maybe for a whole bunch of things, right? And you might have 30%. These are abstract numbers. I'll have some the exact numbers another time, right? But you might have, let's say, 60% in terms of your spending bucket, right? Your wants and your needs, right? And let's say 20% or 25% or whatever the case might be in your savings, right? Now, that's a lot, because at that age, most people, even much older, are not saving. But I'm just using that example. And then you might have 10, 15% or more at that young age, right? If you have more money invested, the better. But at least 10%, I say, should go to investment as early as possible, right? As early as possible. Another thing is this. When it comes to all the buckets, whether it's spending, saving, or investing, you want to think about automating. This is key. Automate. What do I mean by that? So that in the same way, when we get a subscription to Netflix, to Amazon, to Costco, to whatever the case might be, right? Those expenditures, right? Our spending our money is automated, right? You get a subscription, and every month that money comes out. Well, you want to do that for your spending, but on the right things, right? And the reason why I say you want to do it for your spending is because you don't want to, if it's something you need or something that can help you make more money, right, or save you money, then you don't want to be trying to remember. You don't want to rely on discipline or what do they call it? Can't think of the word, but basically discipline to to remember to do what you're supposed to do in terms of spending, right? Instead, you want to make sure that you automate, right? So that's the main thing. Willpower. That's the word I was looking for. You don't want to rely on discipline or willpower to do these things when the better way to do it is to automate, right? So that's the spending plan. Now the savings plan. Savings, as I mentioned earlier, you have a couple of options, right? Some people suggest that you have 5, 6 different savings accounts. I don't know if I agree with that. To me, I think it can become unwieldy, becomes a little hard to manage. But if you have 2 or 3 accounts, fine, and maybe have different names with different purposes. So, for example, you have a savings plan for college, right? For your college, your further your education, or a child's, right, or a grandchild, or whatever the case may be. You might have a savings account for vacations and trips or family or whatever the case might be. So you give it a name and it has its own account. That's one way to do it. Or you could just have one account and be very clear about what it's for, right? Some people just say, well, I'm just saving for a rainy day, or call it a rainy day fund, emergency fund, or whatever the case might be, but give it a name, right? And in the same way as in spending, with your spending plan, you want to have a savings plan that's based on automation. So a certain amount of money, if you get $100 and 60% or $60 in this case goes to spending, I'm just using that for example in terms of percentages, and let's say 30% goes to savings. Again, that's a high number. Most people don't save that amount. But let's say, you have $100, $60 goes to spending, $30 goes to savings, right? For emergency fund, and 10% should go to investing, right? You're going to always hear me come back to investing, right? And you might ask, well, but I got credit card debts. I have all these other things. I just don't, and I feel, I don't know how I feel about investing. I'm going to get into it in a minute. But I really feel strongly that even if it's a very small amount, you want to get in the habit of investing. I'll just say that. Now, savings, again, I would not encourage anyone to get a regular savings account, right? Most of them, a lot of them, with the big banks, Chase and others, right? I bank with Chase, and they are very stingy. They're very tight when it comes to the different accounts they have, right? So you're not going to get any interest on many of those. Now, if you get a high yield savings account, right? Again, at this juncture, at this time, you might be able to make, or your money might be able to earn 3 to 4% a year. But now inflation is up, right? Inflation is rising, meaning the cost of goods and services in America and in many countries keeps going up. And this war does not help it, right? So what that means in practical terms is that my dollar, has less earning power, meaning not earning power, spending power, right? So that a dollar today will buy less than I was able to buy with it 6 months ago. That's the real life impact of inflation, right? I remember not too long ago in my neighborhood, I used to get a slice of pizza for $1, like just a regular pizza. We didn't talk about anything fancy. Talking about we on the go, $1, right? Now they're $1.25, depending if you're lucky, right? Most of them $1.50. Just think about it. That's a 50% increase. Seems like no big deal, right? But that's a 50% increase. If you had $1 and it earned 50 cents, right? And now you have $1.50, your money has increased by 50%, and that's huge. If you have $1,000, now you have 1,500. If you have $1,000,000, you have 1.5 million. It's a lot of money, 50%, right? So it's not the amount, the size, the dollar amount. It's the percentage increase, right? And it's a percentage increase over, a certain period of time. So if it increases quickly over, in a short period of time, then obviously it's going to hurt you more, right? All the more reason to put your money to work, so that when it comes to savings, it's not so much putting your money to work. Saving is more about protection, right? You want to think of it as almost like quiet insurance, but think of it like insurance, short term, maybe midterm insurance, right? You can think of it like that, right? Because if you just spend your money, then you have no protection. The money is gone, right? When you need it, especially when you need it, right? But you want to get in the habit of saving, automating spending, automating savings, and then last but not least, my favorite part, investing, having an investing plan. People say a whole bunch of things, right? People think that you need a lot of money to invest. That is not true. You don't need a lot of money to invest. People think that it's only for rich people. That is not true, right? People think that it's risky. Yes, there is some risk, right? But no more risk than a lot of other things, right? If you keep your money in the house and then, God forbid, some there was a fire, it got misplaced, somebody stole it, or whatever the case might be, you know, anything can happen, right? That is risky, right? And even outside of money, just life. Like, I mean, just I live in New York City, and like a lot of places, we have problem with homelessness and mental health. So sometimes crazy things happen on the train or the bus, public transportation. So it's risk is always around, right? The thing is to mitigate the risk, to minimize it, and to do your homework, to do your research, right? Not to just go off of impulse again and just buy something because somebody recommended it or because you think you're going to make money really quickly. That's not the reason to invest, right? So again, when it comes to investing, investing is about long term. It's not so much protection. It's not the present as we have with spending. So you got spending is the present. Uh, Saving is more about protecting for some future, right? Usually not long term, but some future occurrence or event or whatever the case might be, or goal, just a future goal, right? And then when it comes to investing, you're thinking long term. When I think of investing, I'm thinking 5 years and better, right? Not a year, 3 years, whatever, 5, 10, 15, 20. I'm thinking along those lines. Some people think a lot further, right? They think in decades, right? And that's a great thing, right? The whole point is to think long term. And with investing, it's a whole different mindset for one, right? And that's key throughout all of this. People who spend, that's a certain mindset, right? For whatever reason. It could be trauma, and we'll get into that in some other episodes, right? But it could be trauma, it could be boredom, it could be trying to keep up with the Joneses, whatever the reason, right? Um, it's a certain mindset. Saving, right? Or a person who saves has a different mindset than someone who spends all the time, right? So they spend, we all spend, but someone who's a saver, some people are really, really good at saving. The money's not growing up, but they are saving. They're accumulating money, not wealth, but usually money over time and gradually, right? That's a certain mindset. And then when it comes to investing, that's a long term mindset, but it's also a growth mindset. And it's also one that is based on having money work for you. That is key. That is key. So saving, your money is not working for you. It is, it's like I said, it has a protective posture, so to speak. But it's having your money work for you. That is really critical, right? And that's why I love it so much, because one of the things they say, and it's really true, is that when you invest, and it depends on what you invest in, and again, it's risk, so it goes up and down. Uh, when your money is working for you, you are essentially making money while you sleep. That's what I love about investing. One of the things, right? That I don't have to work for, right? It works for me because money is meant to be put to work, right? That's what cash flow is about. If it stands still, if it's still, it's in a savings account. It's actually not standing still because the bank is going to take your money and my money and they're going to invest it because they know the rules of the game. And the rules of the game is to have money make more money, right? That's the name of the game, right? Not for it to be still. It has no value if it's just stationary, right? If it's not being put to work, if it's not doing anything, it really has no value. It's just a number, right? It could be 1,000, 10,000, million. It really it's just a number. It's only when you put it to work, right, and you have it uh, kind of connect with other dollars, right? Meaning you have your money uh, attract more money, then it attracts more money and attracts more money and attracts more money. That's one way to look at it, right? So that's what compound interest is about. You got regular interest, standard interest, right, which is incremental. You get a percent at a time or a certain small amount that the bank might give you every single day, fraction of 1%. But when your money is invested, it compounds. You have interest on top of interest on top of interest on top of interest. It works for you. So, in a nutshell, that's what the SSI method is about. I will, over time, over the next couple of weeks and months, we'll dive into each component of the more deeply, right? The spending plan, the savings plan, and the investing plan. We'll dive into each of those pillars. I will be taking questions. All right. I see some comments. I didn't see that. That's my bad. I apologize. I apologize. Yep. How do you control my spending, living check to check? Okay. Got you. All right. I see it. All right. Gotcha. All right. So I didn't see that, like I said. So, all right. Let me answer a few of these questions before we wrap up. How do I control my spending, living check to check? Good question. Very good question. The first thing is to acknowledge that you have a spending problem. It's like anything else. If you have a gambling problem, a sex addiction problem, alcohol, drug problem, is to admit to yourself that you have an issue, right? Doesn't make you a bad person or anything like that, but that you have an issue and that you want to get better at this, right? So that's the first thing. And then what I say, or suggest, is that you take the last 2 to 3 months of your, let's say if you have a savings account or checking account, right? Collect your statements, your monthly statements. Get the last 2 or 3 months. You don't need to go back 6 months, a year, anything like that. We are habitual creatures, so the way we spent money last month is very close to how we spent it the previous month and the month before that. Every now and then we might have something like I got, the next couple of months got a lot of vacations coming up, so it's going to look different than earlier in the year. But for the most part, most of the expenses, the line items are pretty much the same, right? And so I would start there because we sometimes we have to see it. Like, I mean, not sometimes, we do need to see it with our own eyes, how we're spending. It's one thing to, at the end of the month or the middle of the month, to not have any money and to say, damn, where did the money go, right? And that's when you don't have a spending plan. That's when you don't have a savings plan or investing plan, right? You have no idea where your money go. You can remember a few things you bought, and then the rest you're like, I don't even remember. That's what the SSI method is intended to fix or to address, right? So again, we're not talking budgeting. We're talking about being in control of your money, and we're talking about giving each dollar a purpose, right? Some is for spending, some is for investing, some is for, savings, and some is for investing. It's really that simple. 3 different purposes, and then for each of those baskets, you're going to allocate it a certain way, right? So again, living paycheck to paycheck, and at the end of the day, most of us still, even if we're living paycheck to paycheck and we can feel the pinch and the squeeze of inflation and all these things, we still, I don't want to say squander, but we still spend money. Most of us spend money on things that we don't need, right? Now, that's not to say that you shouldn't treat yourself to anything, because that's what most people say. Well, I work hard for my money. I only make, X amount of dollars a week or month or whatever the case may be. All those things may be true, but I guarantee if you're honest with yourself and you look at your statements, and that's why it's always good to have a bank account, not be what they call unbanked. It's the worst people, I think, that in terms of like struggling with money is those who don't have a bank account or don't have some way to digitally be able to track their funding, right? They don't have a savings app, they don't have a cash app or anything like that, and they just use cash, right? It's hard to track. Most people, we don't keep receipts, right? If you keep receipts these days, that's great. And they have apps that you can track and all that stuff like that. But most people, if you don't have a bank account, checking account, or anything like that, you don't have any idea how your money is being allocated, how it's being spent, right? From day to day, you really don't know. So that's the first thing, is to get that under control, to visually take a look at how you're spending your money right now, right? And how you've been spending over the last, let's say, 3 months or so, right? So that's the first thing, right? Another thing, now you say, spending, spending and living paycheck to paycheck, is you could always, while you're looking at how you're spending your money, right? You should do that, of course, but you should also think about ways, it could be legit side hustles and things like that, to increase the amount of money that you bring in, right? In addition to a paycheck, right? Right. If you get a raise, you can ask for a raise. That's another way to, obviously, to bring in income. But if you don't get it, you might have to get another job, or some type of side hustle. My point is that you want to look at how you're spending, how you're already spending money, and also how you can bring in more money. Now, the key is you don't want to bring in more money just to be going, again, like paycheck to paycheck, or living hand to mouth, as they say. As you bring in more money, let's say from a raise, a bonus, from side hustles, a gift, or gifts from people, you want to be thinking in terms of spending, saving, investing. How much am I going to put towards spending? How much am I going to put towards saving? How much I'm going to put towards investing? You always want to think like that. That is the starting point. Doesn't matter the amount of money or the source of the money. It's having a system. That is key. It's going to make all the difference, right? Now, if you want to know more about this, right? Because I just touched on the surface. You want to know more about this, you can check out my free. You can check out the free SSI Method Starter Guide. Check out our website, thinkoutsidethecell.com, right? Think outside the cell, CELL, right? .com. And you'll see all free resources. We have other resources. We have free guides, some paid guides. We have books. We have a whole bunch of stuff to set you up so that you and your loved ones can be in a good space when it comes to money, right? And so definitely check out the website, and there'll be more resources. And I promise you, by the time we do this next week, because this is every Monday at 3 o'clock, 3 p.m., we will have we will have our slide deck together, right? So with that said, I'm going to stop sharing the screen because I was unable to get okay, there we go. Unable to get it all set up, but we will get it set up. And this is your boy Joe, the Wealth Architect. Again, thinkoutsidethecell.com. And let me just say this: it's not just for people who serve time, right? Thinking outside the cell is a mental framework. It's a way of being. It's a way of being, right? We don't want to think limited, and often because we have bought into different, I can say, misconceptions about money, and we have like really bad relationships with money, different feelings and emotions around money. We are in a cell. We are in a prison. You can be physically free and mentally and emotionally incarcerated. So we want to decarcerate, right, people, you in particular, from any thoughts, habits, beliefs that are holding you back from having the wealth, the freedom that you and your family deserve. So again, it's your boy Joe, the Wealth Architect. Be sure to like the video, subscribe to the channel, right? Creating New Investors on YouTube, on TikTok, same thing. Well, on TikTok, it's Think Outside the Cell, and it's Joe, the Wealth Architect. We will get all set up. I promise you, everybody started off like this. That's why I didn't stop. I just kept going, right? We're going to keep going. We're going to get this money. And with that, I say peace.